In this episode of Fill the Boot, I'm joined by Josh Aharonoff, a fractional CFO who helps fast-growing early-stage startups with everything from bookkeeping to putting together financials for investors. If you're curious about when you should start bringing in financial help, who to hire, how to avoid critical finance mistakes, and what investors want to see in financial reports, Josh has you covered. Whether you're pre-revenue or raising your Series A, this conversation will give you the step-by-step information you need to get your finance house in order. And if you're thinking about raising your next round, I've created a quick quiz to let you know whether you're ready to start reaching out to investors. I'll put a link down in the description. Josh, welcome to Fill the Boot.
Thanks, Lance. Good to be here.
So I really appreciate you joining us. Let's start off by having you maybe just give a brief introduction for who you are and what it is you do.
Cool. So I am a fractional CFO for fast-growing companies through our company, Mighty Digits. I also am the founder of a SaaS tool called Model Wiz. It's an Excel plugin that allows you to do cool automations with dashboards and financial models. And lastly, I share finance and accounting insights every day to an audience of over 400,000 people.
Fantastic. So a lot of the people who we're talking to who, watch Fill the Boot are very early stage companies. They typically don't have a lot of structure or process in place, particularly around finance. I think that most founders aren't thinking about the financial aspects of the business unless they're specifically fintech founders. So what kinds of things should an early stage company be making sure they put in place, and when do those need to go in? In particular, what do they need to be worried about if they're, for example, even pre-revenue at this point?
Good question. So I like to think of a finance and accounting function in different stages. And of course, everyone starts at stage one. Stage one, to me, it's really just important that you're keeping track of your cash balance, you're checking your bank periodically, you're making sure that nothing is going off the rails. But most importantly, you're staying compliant. So you're hiring a tax professional at year end. That tax professional oftentimes will just do your bookkeeping, make sure that you guys are remaining compliant with your federal and state tax returns, with any sales tax you may have, with your Delaware franchise tax, 1099s, and so forth. It's up to you in the early stages if you want to get an accounting software. There are a lot of efficiencies and automations you can take advantage of. But again, when you're in the very early days, you really just need to make sure you're keeping track of your cash balance and you're staying compliant.
Now, do people need to be worried about things like, GAAP accounting or versus cash basis or things like that? How far down do they need to be getting when they're trying to keep those books in order?
So I'll just do a really quick overview for those who aren't aware of the difference between cash basis accounting and accrual basis accounting, which is in accordance with GAAP, generally accepted accounting principles. Cash basis of accounting is really simple. It means you're just classifying transactions when they enter your bank account as deposits, as income, when they leave your bank account as expenses. Under accrual accounting, you're actually focusing on whether you earn the income yet by delivering your product or service, or whether you consume the expense yet. So most companies, when they start off, they really just opt for the cash basis because it's super simple. You don't really have maybe too many outside investors who want to see things differently. And that's totally fine. It'll save you a lot of time under the cash basis. But generally, as a company matures, it's very common to transition to the accrual basis because outside investors like to understand what exactly is happening in the business. And eventually, when you get to the point where hopefully you have an IPO and you're a public company, you don't actually have a choice. Then you have to go under the accrual basis of accounting.
Got it. And there's certainly a lot of complexities and so forth to that. I remember having to learn some of that. But I like cash basis accounting in the very early days just because the company runs out of money on a cash basis. That's where the rubber meets the road if you can't actually cover payroll and write checks for the services and subscriptions that you've got. So what do you see as the most common mistakes that founders are making, and what kind of things do you find you need to help them kind of dig their way out of when they bring you in?
So typically founders get to a point, they have an inflection point. Either their business is growing so quickly, which is a champagne problem, that what worked in the early days doesn't now work in the later days. Or they're about to raise capital, but their investors are saying, hey, your finance and accounting, your financial reporting, it's not really up to par. I don't feel comfortable giving you my money until you fix that. So I don't know if I would say that there are too many mistakes that happen before that point, as long as the founders aren't spending a crazy amount of time in the finance and accounting function and are spending as much of their time as possible trying to find product market fit and actually grow their company. When companies do hit that inflection point, a common mistake that I see is founders who initially have maybe an MBA, they maybe even have a finance and accounting background themselves, and they're the ones who are handling it, eventually get to the point where a few hours a month turns into a few hours a week, maybe even a few hours a day. And although I definitely am biased and I think finance and accounting is super important, again, I don't think that's where a founder should be spending their time. So I would suggest when you do hit that inflection point, hire a freelancer, hire an outside firm, do whatever you can so you could focus on the more important picture for a founder, which is growing the company and the culture.
So you mentioned that often this is driven by the investors looking for sort of more robust kind of accounting or different kinds of accounting. When do you tend to see that coming in? Do you see that with early angels, or is that more into the seed A round when there's more kind of financial activity going on in the business?
Yeah, Series A, almost definitely. You'll see investors become a lot more focused on the actual financials. Ideally, they want to see projections. They want to understand what you're going to be doing with the cash, because now we're talking about tens of $millions that they're going to be investing. It's possible you'll be seeing that as well. I found just from my experience, every investor, of course, get different. Every company and industry is different. When you get to the seed point or anything prior to the seed point, it's really just about proving that you understand a lot about the market. Ideally, the founders have a really good track record as well. And there are early signs of traction. I feel that getting to the Series A shows that you have product market fit, and now it's time to really scale things.
Yeah, it's interesting. I found that there seem to be real geographic differences as well in terms of what people are looking for. So you've got the classic Silicon Valley investors who are all about the potential market size, and current revenues and things like that just don't matter. But you look at, for example, New York tends to be a little more fiscally oriented, and Europe even more so. So depending on where you are and who you're talking to, yeah, the audience can vary quite a lot.
For sure.
So when people are starting to look at building this out, what should they be hiring first? I mean, probably they don't need a full-time CFO on day one, but what are the sort of the markers for when you should bring people in, and what order do you think people need to do that?
So generally, a CFO to me is not something that you need really until like earliest Series B. And that's given the fact that CFOs are both super expensive, as well as you don't want to have a CFO come in and do bank reconciliations or process payroll or manage payments with vendors. So in the early days, when you're starting to make your first hire, whether that's a full-time in-house hire or whether it's a freelancer or whether you're working with an accounting firm, you want to think about what are the things that you need assistance with and what is your budget. And generally, what I see founders do is they make their very first hire as an admin, as a bookkeeper. And again, in the very early stages, when the founders are the one who are doing it themselves, that usually is the best route because that frees up the founder's time, and it's not rocket science. You have to know how to classify two transactions, especially if it's on the cash basis. There's not really much to it. What then becomes tricky is as you then start to graduate, your investors are starting to request more detailed information. You're no longer reporting maybe on the cash basis. You want to report on the accrual basis. It's not so common for a junior hire that may be a freelancer to ultimately be able to handle the full picture, build a robust financial model, and help you raise that capital. So a lot of time founders, although I may sound biased, turn to a fractional approach where they work with a company, they get a fractional bookkeeper, a fractional accounting manager, a fractional CFO, and for one rate, without having to pay health benefits or payroll taxes, they can kind of get a little bit of everything. I see founders, I'm just going to finish on this last point with that in-house hire. The most common in-house hire that they make is typically a VP of finance. And that's usually in between the Series C, more likely the Series A level. And that VP of finance will oversee the entire function and will most likely manage whatever resources are already in place.
Yeah, I think that makes a lot of sense. I actually used a fractional CFO myself, and turned out to be really, really useful because you could reach out and touch them for those strategic financial discussions that you needed to have and thinking about the high level aspects of what you're doing. But it was not day to day, right? We didn't need them all the time. We could just reach out, take advantage of that, and then save money the rest of the time by, just using the bookkeeper or whoever was doing that on a day-to-day basis to keep the company running.
For sure.
So once you're starting to work with someone, say you've got a bookkeeper, what should you be asking for in terms of financial metrics to make sure that the company stays kind of on the straight and narrow and right side up?
So I'll expand a little bit on financial metrics and just say in general, what should you expect from a bookkeeper? Bookkeepers, for the most part, start off with the financial reporting, making sure that all of your transactions are classified. Once you classify those transactions, you then want to reconcile them, confirming they match to your bank account, to your credit card statement. And then if you're under the accrual basis, you may need to also book adjustments. Those adjustments can be, let's say, if you receive a cash deposit for a 12-month contract, booking it between revenue and deferred revenue and other things like that. So just making sure that you have a well-oiled machine with your financial reporting for your sake to understand what's happening in the business, how much money you're spending, and then also for your investors' sake. The more capital you raise, the more reporting requirements you're going to have. But in the early stages, you'll also want this bookkeeper to handle a lot of the administrative things related to a finance and accounting function. So like we spoke about earlier, that can involve collecting bills from vendors, collecting approvals, processing payments then on the due date and upon the approvals, invoicing customers, processing payroll from employees, dealing with state tax issues, forwarding them to the right department, and so forth. That's how I think of a bookkeeper in the early stages of a company.
So why don't we dig a little more into deferred revenue? Because I think a lot of people are unfamiliar with that. I certainly was when I started, but it's something that, especially with SaaS companies and the big move to subscriptions, really applies to almost all of the startups that I see.
Sure. So going back to that difference between cash basis accounting and accrual basis accounting. Again, cash basis accounting, all it cares about is, did you receive the money or did you pay a vendor yet? When you receive it, it's income. When you pay it, it's an expense. The accrual basis of accounting cares about when exactly the activity took place. So with revenue, let's say you're selling access to your platform for a 12-month period. If you charge, let's say under round numbers, $12,000 for the entire year. Like we said, under the cash basis, you have $12,000 in revenue, $12,000 in income for that period. Under the accrual basis, you need to think about the actual life of your contract. And you can't just record all 12,000 of that income in the first month because you have another 11 months of access to your platform that you need to share with your customer. If you were to close down tomorrow, you were to have a bug and all of a sudden your web servers weren't up and running, you'd have to return that money. So you in essence record $1,000 each month, and the balance goes to your balance sheet in an account called deferred revenue, which is a liability because it's something that you owe.
Got it. Now, I think it's really important for people to wrap their heads around this when they're looking at these numbers, because it changes things radically when you are starting to take that into account. You do a big contract in December, almost all of that ends up landing in next year if it's an annual contract.
Exactly.
So how should someone think about structuring this? Now, before they hire that VP, when they're starting to bring in people, how do you organize that accounting function in a startup?
So in the early stages, again, it's fine if a founder is handling it themselves. If they have a good grip on it, there's not really too much to it. And ideally, it's less than, let's say, 5 hours a month. As that starts to exceed a founder's time, you then want to hire some sort of fractional support, whether it's a bookkeeper, whether it's an accounting firm, so you can get those things off your plate and so that you could actually do a lot of the things that you may not even be able to do correctly. So in terms of structuring the entire finance and accounting function, again, just backing up and talking about the different areas, there's your financial reporting, there's your accounts payable, your invoicing, your payroll, and your taxes. So you just want to have a mix of people who know what they're doing, who could take away the administrative burden of the founders actually doing it themselves and keep you compliant.
And so with compliance, what are the places where people typically get out of compliance? Where are the mistakes or the pitfalls that they're going to run into?
So a lot of people, I think, or rather I would say it the other way around, very few people forget about their actual federal and state taxes. They recognize it's beyond their pay grade, they hire someone, so it's pretty rare that a company is not in compliance when it comes to that. What I see companies oftentimes be in non-compliance with is sales tax. So the way sales tax works is if you're selling digital goods, digital or even physical goods, you need to charge an additional amount to your customers. And then when you collect that amount, you need to remit it to the government. So it's technically not an actual expense to the business like an income tax would be, but instead it's really just a pass-through. You collect it from one person, you then pay it to another. But what a lot of founders don't realize is Sales tax is incredibly complex. All taxes, unfortunately, are incredibly complex. And there are different rules for each state. And if you're international, it could also be, they call it VAT, VAT, value added tax. In the US specifically, it's called nexus, whenever you actually cross a threshold for the requirements for now when you need to start collecting sales tax. And unfortunately, every state is different when it comes to sales tax. So you really need like a third-party software tool. You could hire a professional, but generally all of them use some sort of tool to keep track of the ever-changing rules for nexus in each and every state.
Are there any particular tools that you recommend to people, especially, that are sort of scale appropriate for a small company?
For sure. There are a few. So Avalara probably is one of the most popular solutions out there. There's also Anrock, then TaxJar, which is a service that Stripe offers because a lot of founders use Stripe. That's helpful to just have it already plugged in directly. Another tool is Paddle. I haven't used them, but I've heard good things from other people where they'll actually become an employer of record. So instead of you having to collect the tax and remit it on your own and register in each and every state, they'll just handle it all directly, much like a professional employer organization will handle your health benefits and payroll taxes for payroll.
Got it. Right. And payroll is another one of those things that I discovered was hugely complex. I remember back in the 90s when I was starting out, I was talking to my tax accountants about how to manage payroll, and they go, "Oh, well, we outsource that." And I figured when my tax accountants were saying they outsourced it, it was probably a good sign that maybe I should not be trying to handle that on my own.
For sure.
So what changes as things scale when a company's going from, pre-revenue to making a few thousands of dollars to now they're getting into, they're doing $1 million to 10 million ARR? How does that change things?
So two of the biggest things that change, again, going with the idea that you always want to make sure the founders are not being bogged down by this type of work. But outside of that, the need for external reporting as well as internal reporting goes up exponentially. And it makes sense. If investors are pouring in tens of millions of dollars into your company, they're most likely taking a board seat. They want to confirm that that money is being wisely spent. They want to understand what your projections look like. Are you hitting those projections? If not, what's the reason for why you're not? It would be any investor's nightmare if they invested a ton of capital and it just disappeared the next day. Similarly, founders themselves need to understand what is happening financially in their business. They don't need to know the details behind ASC 606 and different GAAP requirements. They just need to be able to understand where is their money going? Are they growing? Are they shrinking? When is their cash out date? And so forth. So for that reason, the number one tool that I think a company should invest in, especially as they surpass that Series Seed level, is a financial model. It's in essence a combination of a forecast of where the future is going, where the company is going, which can be tweaked with a few levers, as well as a historical readout of where the company has been that ideally blends really nicely from one to the other.
So you provide some fractional CFO services, and we've talked a little bit about CFOs, but I think a lot of founders are not really familiar with what that role provides. So could you maybe talk a little bit about what should someone expect from a CFO? How do you work with someone like that within the C-suite of the organization? How do you make them as effective as possible?
So I'll first say that the term fractional CFO, it's a pretty loose term, just like a CPA or an accountant can also be a fairly loose term. The way that I think of a fractional CFO, this is someone who gets involved specifically in managing that financial model, who gets involved in your investor and board of directors relationships to ensure that things are going smoothly, they're getting the information that they need, they're getting the story that they need, and so forth. So one of the biggest areas that a fractional CFO will invest in is this financial reporting function. They may not be the ones who actually does the bookkeeping and the month-end close, but ideally, they're very familiar with the process, and ideally they have an accounting background so they understand double entry accounting. But where a fractional CFO really shines is then creating that mechanism where the founders, management, they could understand everything every single month that's happening in the business as it compares to their budget, as it compares to the prior year, to the prior period, what the next few months are going to look like, the next year, and so forth. One who could really manage that function as well as the investors and the board of directors.
Got it. So as the CEO, the new founders bringing in a fractional, or maybe they've left it longer, they're bringing on a full-time CFO. What sort of question should they be asking that person, assuming that that new person is not sort of driving that conversation and offering things up?
Well, I think a lot of it has to do first with the type of company that you are and the industry that you're in. Some fractional CFOs excel at working with early stage startups. Others excel at working with non-for-profits, other with CPG companies, manufacturing companies. So really just gathering that industry experience, I think, could be a really good place to start. And then understanding what type of projects has this fractional CFO been involved in. It may not be so common once you get to Series B and Series C to work with a fractional CFO. And when you get to Series B and Series C, oftentimes there's venture debt involved. There are all sorts of liquidity optimization strategies involved. It's good for a fractional CFO to have that experience. But again, most of the time, a company will bring that in-house. And maybe the fractional CFO is part of a larger firm where they're continuing to offer support at a lower level, like bookkeeping or other administrative stuff.
Got it. So what do you think, how does the finance function help with fundraising, especially at the sort of the pre-seed and seed levels?
So investors are always going to have a list as part of their due diligence. They're going to want to understand where has the company been in terms of their financial reporting. So that's going to be a standard profit and loss, a balance sheet, and a statement of cash flows. So just making sure that that part is dialed in is a huge value add for a fractional CFO. And a lot of times companies, again, especially if they're working with just a freelance bookkeeper who doesn't have a lot of experience outside of just the bookkeeping, they may not have their chart of accounts optimized. They may not be following accrual accounting. So just making sure that the financial reporting on what's actually happening is optimized, that could be a really huge value add. But then taking it one step further, especially as you get past Series Seed, again, investors are going to want to understand, what is your vision for the future? If I'm going to be giving you $20 million, where is this money going? Why do you need this money? Are you investing in R&D? Are you investing in sales and marketing? Show me the blueprint. And you don't necessarily need to convince them that this blueprint is exactly what is going to happen. But you do need to convince them that you thought about it. You understand the industry, the market that you're in. You understand what it takes to scale this company. Because if you don't have that blueprint, odds are you're probably not going to get there.
Now, I see a lot of founders sort of hit a brick wall when they're trying to put together a financial model and financial forecasts, particularly when they're pre-revenue. They haven't actually sold anything yet, and they're trying to put together 5-year projections to give to the investors and to, have that nice hockey stick graph in their presentation deck. What's your suggestion? How do you help founders kind of think through that process, and what's your approach to building those models?
So similar to a finance and accounting function having different stages, I like to think of a forecast also having different stages. And typically when you're at the Series Seed level, you're building a stage 1 or a level 1 forecast, which really is just a basic revenue build. And ideally with that revenue build, you're showcasing how inputs result in outputs. You're not just saying, okay, I think I'm going to do $1 million in sales this year, 5 million next year, or hey, the entire market's worth 10 billion. So if I just take a fraction of a percentage, that'll be $10 million next year. We're all guilty of doing that at some point, but that's not really a defensible way to build a revenue forecast. Ideally, you showcase an investment in paid ads, an investment in sales reps with a ramp period, with a quota. That's what ultimately leads to us having revenue. As you graduate from a level 1 forecast, you then attach a P&L. So you may showcase, for instance, your headcount, which is going to be your largest expense, which again, when you get to the Series A level, investors don't want to know only how you're going to grow the company, but how you're going to actually use their cash, how you're going to stay ultimately above the level where you won't have to raise capital in another 6 months or so. A level 3 forecast is one that I like to think includes a balance sheet and a cash flows, which is all dynamic now. Any changes to your income statement and balance sheet can automatically showcase in your cash flows using the indirect method. And then finally, a level 4 forecast includes all of that in addition to all of your historicals matching to your accounting software, along with beautiful dashboards where the founders and investors can get really quick insights into all the information that you need to share.
So do you have any sort of favorite tips or advice that you give to founders that you're working with sort of most often? What's the number one or top couple of things that come up?
So when I build a financial model, I like to do it in this order. First and foremost is your revenue build. of the hundreds of financial models and forecasts that I built in my career, I've never had a company with the exact same revenue build and business model as another's. Everyone's a little bit different. It's like snowflakes to me. So that's generally where the bulk of the time that I'll spend with the founder when I first start working with them. And that's a really good value add because, again, this is your business model. This is what drives everything. The next biggest area that I'll spend when I work with a founder is their existing headcount as well as their projected headcount. Because, again, that's going to be the largest expense 9.5 times out of 10. So making sure that you have really accurate calculations in there, not just for what the salary is going to be, but also the payroll taxes, the health benefits, and not just using a smooth number, but if someone starts in the middle of the month, if they get terminated in the middle of the month, you got to prorate that. So getting your headcount accurate is a huge piece of just managing your actual cash burn. The other two areas that I like to then focus on is just forecasting the rest of your profit and loss, which oftentimes involves a driver similar to like a 6-month average or maybe the amount from a prior year with a buffer of some sort. There really are just a multitude of different ways you could tackle it. And then lastly, your balance sheet. How will you forecast out each area of your balance sheet? Your inventory, your accounts receivable, your accounts payable, your CapEx, and so forth. Once all 4 of those are done, you then have a robust financial model.
And I always like to see that because when I look at the models for early stage companies, I mean, my first assumption is they're wrong because it's very, startups are so wildly divergent in terms of what happens and reacting, but it tells me a lot about how they think about the company and what measures they've done. It's always kind of disturbing when I see someone has plugged in, 20% monthly growth, and it's just a fixed number in their chart that, revenue is going up by 20%. It's like, why? What? Making it more of a bottom-up approach so that you can support that. If I ask you a question, you've got a better answer, then that seemed reasonable.
Exactly.
So is there anything that you'd like to promote or talk about? Where can people find you?
Sure. Well, a few things. First, you could find me on pretty much any social media channel, Your CFO Guy. LinkedIn is where I have my biggest audience of over 400,000 people. I have a daily newsletter as well where I share finance and accounting tips that just crossed 100,000 subscribers. I'm also actively working on promoting and building up our YouTube channel, which has been a really fun experience. And again, I have an X profile, Instagram, pretty much everything out there. So that's my social presence. If you need a fractional CFO or you just need advice for your startup in any sort of a way as it relates to finance and accounting, you could reach out to me at josh@mightydigits.com. And then lastly, like I was mentioning earlier, I actually have an Excel plugin that will connect to your accounting software and build a forecast connected directly to your data, sharing a bunch of really beautiful dashboards. That's called Model Wiz. We just released a free tier last week and we had over 700 signups. So you can check us out at modelwiz.com.
Fantastic. I think those will be great resources. I really appreciate you sharing your experience and insights. I think this will be super useful to most of the founders out there. I appreciate you sharing your time with us.
Thanks, Lance. Great to be here.
I hope you found my conversation with Josh as interesting as I did. We covered a lot of ground, from who and when to hire into your finance roles to key financial mistakes to avoid and what kind of financial information investors most want to see. If you're raising money for your startup and are not sure if you're ready to start pitching investors, check out my quiz that'll tell you whether you're ready to go. I'll put a link to that down in the description. If you want to explore some more around how to validate all of the assumptions in your startup to make sure that you're ready, I encourage you to go check out this video here, my interview with John at PickFu about his tool for validating ideas and information around your startup. And until next time, ciao.